We start off with a star-spangled sign of the times. Before you fire up the grill this July 4th weekend, we've got some big news on the state of the American consumer. The jobs report coming in better than expected, the U.S. adding 850,000 new jobs, and people are getting paid more. Hourly wages for non-supervisory roles in leisure and hospitality industry up 2.3%. Huge gains there. Bank of America reporting credit card spending is up 19% for over a 2-year period for the week ending June 26th, with growth in travel, entertainment, and dining out especially strong. So as we head into the long 4th of July weekend, is it all fireworks for the great American consumer? Steve Grasso, kick it off.
So payrolls, there's still some slack in payrolls. We're still about 6.7 million below pre-pandemic. That's number one. So you have slack in the labor market, so we're not so worried about inflation just yet. People who have a job, keep the job. People who don't have a job are going to be coming off aid in when? September, I think the number is. What's the extra check right now? $300. Jump in whenever you know them, because I'm not so sure about the numbers. So $300 is extra on top of unemployment, on unemployment checks. That's going to be rolling off. So I'm a little perplexed. Does the economy keep rolling, or do we see a pullback in September?
So you're questioning.
I'm questioning it right now. And just to put a bow on my thing, Costco, all-time highs. Nike, all-time highs. XLY, discretionary,
so you think it's
all-time
toppy.
highs.
You think it's toppy here?
I feel like it could be a touch toppy. So there are some pockets of strength, but I think in September, that's make or break, and that's real pivotal going into year end.
I like the self-bow for Steve Grasso. Mike Khouw, what do you think of the consumer? It feels like the consumer is still ready to spend. They're getting signing bonuses for new jobs because the labor market is so tight. They've got the upper hand when it comes to wages.
Yeah, I mean, so, Steve was pointing out that that total payroll is lower than it was pre-pandemic. But wages for non-supervisory roles are higher. Actually, month on month, I think we saw 1% month on month. That may not sound like a lot. Annualize those kinds of numbers, and you begin to realize what kind of a demand there is for labor right now. So I actually think this is poised to continue. I mean, we are at all-time highs. We did see the VIX actually hit a post-pandemic low today of about 14.5. That actually is about the mean level for the VIX actually in all of 2019, to give some perspective to how much complacency is built in. Now, you could argue that complacency is, basically signaling that, hey, maybe it is time to look down. And I think there is some sense to that. But actually, one of the things we do see is that when volatility starts hitting these low levels, you do tend to have a relatively extended rally. So I think it could actually persist possibly for another week or two. But I do think it is time to start thinking about hitting the pause button at least.
Volatility being low at least allows you to buy protection relatively more cheaply than in other periods. Tim, how are you feeling about the consumer? And to Grasso's point, maybe these all-time highs were anticipatory in terms of, the stock market leads. And so maybe this is telling you something.
Well, the bond market is telling me something, Mel, and so we had a closing yield on the 10-year of 143, takes you back to March 3rd. That doesn't jive with the fact that the economy is booming and that there's a shortage of labor and that ultimately folks are getting paid more and it's going to trickle through to the economy and there's inflation. And there is inflation. We've spent a lot of time talking about it, and we've talked specifically, and I think today's payroll number shows you where services inflation is a very big part. Peter Bookvar talks about this. A lot of other folks that I think are smart and tuned into this dynamic. And I think, look, I get the feeling we're going to continue to see this liquidity dynamic both in the consumer's wallet, that which is coming from the government and that which has come from the Federal Reserve, continue to support those consumer trades that are kind of first derivative. So it is Target, it is Costco, it is Home Depot and Lowe's. Look, they had a tough late May, early June, have turned on a dime and are soaring to all-time highs again. Yeah, a Lululemon, even an L brand. So the discretionary spend to me is something, like Mike said, I don't think this ends anytime soon. And in fact, the underemployed and the fact that plants are closing because they don't have chips or they don't have certain parts. I mean, those are things those are transitory. And ultimately, I think the labor in the form of wages is something we're going to continue to hear about. But I'm concerned that the bond market, which is usually a step or two ahead of the equity market, is telling us something. I hate the fact that we're the lowest yield in the 10-year at a time when the economy should be expanding since mid-March.
So it sounds like you're bullish in terms of the immediate term, the near term, but you're cautious about a little bit out just because of what the bond market is telegraphing. James, where do you fall in this debate?
Well, it's no coincidence that we're looking at the 6 consecutive months of job recovery gains, and that is the same time period since the vaccine was announced. And so we've got a march towards normalization in the labor market and in our economy. And the pockets that were hit hardest in COVID obviously will show the strongest resilience and recovery. But in the leisure and hospitality space, we're still 2.4 million jobs below the February 2020 level. And so we can see an acceleration of recovery in those two sectors and look for opportunities there. And then also in the overall labor market, the labor shortage, if you will, from people falling off the map in terms of seeking employment. We're still 3 million laborers below the February 2020 levels. And so as this recovery continues, you want to kind of look at where the pockets of accelerated recovery are happening and look for opportunities there. Overall, we're still looking at a distorted data set because of the benefits that people have received and the changes in behaviors in small businesses, which is obviously the biggest driver. And so if we can kind of separate out the distortions from the industries that were hit hardest, and then those misprints of interpretation of data based on the labor force being a little bit different because of the benefits, I think I would just hone in on those industries that we can see recovery for investment opportunity.
Grasso, you've been in names like a Capri and some others. I'm just wondering how you view your retail holdings, the consumer-facing holdings.
So Capri, I lightened up on. I'm still long it. I'm still long a substantial amount, but I lightened up on it because it had a tremendous move. It hit a wall at that $60 mark. I think you're going to see a lot more strength in a lot of these consumer names, but they are very much due for a pause. So I would take some chips off the table if you're in those spaces.
Yeah. Tim, how about you?
It's funny when you talk about Steve and his capris. I think of aren't capris a very short pair of jeans?
Either that or a juice pouch.
Anyway.
But that's a different conversation.
Yeah, anyway, it is. And I probably shouldn't have gone there. As I look at retail holdings, first of all, Walmart's a name that's been an underperformer relative to this group. We spent some time talking about Walmart in a bunch of different contexts. I actually think that this is one of the more interesting stories. We spent time talking about Walgreens last night and some disappointing numbers, at least on their guide. I think you can find places where there are different reasons, obviously company specific, where you've seen a little bit of underperformance. There's no question that the Costco Targets of the world, because of initiatives they put into place 2 years ago, are reaping those rewards here. But to me, we have a case of an overshoot. We have a case of a consumer that is putting the credit cards and starting to heat those up again. And you have a case where, look, I think the leisure stocks, especially some of the casual dining stores, are places where we are going to continue to see that follow through. People feel comfortable. They feel wanted. They want to go out. They have a couple extra dollars to spend. Prices are higher. They're passing that on to the consumer, and they're not flinching here. And a lot of those trades, and James talked about where the hospitality sector is just starting to get going in terms of their infrastructure and their ability to put people back on the jobs. And I think those are trades that actually still have a lot left.
Yeah. What is due for some catch-up, Mike, in your view, in terms of the consumer or payment-related trades? American Express, for instance, that's extremely exposed to travel. I don't know where you stand on something like that. I mean, where should we start looking?
Yeah, I mean, I think American Express obviously is an interesting one. It's very different, I think, than the other credit card companies. But they are hinged very closely to travel. They're also hinged very closely to business travel specifically. And whether or not, we were just talking about that earlier this week, whether business travel is going to recover, back to pre-pandemic levels anytime soon. That seems unlikely for, there have been some secular shifts in the way people are doing business as a result of all of this. I expect to see a recovery. I'm a part of that. The fact that I'm sitting here right here is amazing. I mean, I don't think I broke out my American Express card for probably 12 months straight, and I've been doing nothing but slapping that thing down for the last 3 weeks that I've been finally on the road again. But I don't know that that's going to be enough, frankly. And I think American Express probably deserves the discount that they have to the other payments.
Another one that's at all-time highs. by the way.
Yeah.
When you look at something like that, and then just one little add-on: Royal Caribbean, Carnival, Norwegian Cruise Line, Delta. All these companies, these transports, are at higher booking rates than they were pre-pandemic.
Right.
Which is very interesting to see the boom in the economy that's still on the horizon.
How can you still invest, James, in the strong consumer and the consumer that's itching to spend?
Well, in the hospitality space and in the hospitality space ecosphere, like Mike, I too have been slapping down my American Express. I'm on the road show. It's my final trade. I like companies that can take advantage of people going back into leisure and travel on top of the season change, right? We're going into summer, so this would be a boost season anyway on top of the reopening. And I like the travel sector and those pockets where we're going to see employment pick up, we're going to see spending pick up, and we're going to see recovery pick up. And this is the area that we've been talking about.
Shepard Smith here. Thanks for watching CNBC on YouTube.